But we can also see we need it over and over and over as the banks are continuing to collapse. We saw this week that Moody's downgrades U.S. banks. As a matter of fact, Moody's credit rating downgrades 10 small and mid-sized banks, and putting the big banks, the giant banks like Bank of New York Mellon, which is America's oldest bank, Trust Financial, State Street, U.S. Bancorp, et cetera, puts them all onto a watch list. So you might have seen a lot of people talking about how these banks that collapsed so far, Silicon Valley Bank, First Republic Bank, et cetera, are sort of just the beginning, and there's going to be this much larger banking collapse happening, which I guess is sort of what Moody's is seeing when they're downgrading the credit rating of these banks. And the reason why this is important is because just like you have a credit rating, and your credit rating determines your ability to borrow. One, can I even get access to liquidity? Two, how much will I be able to pay, or do I have to pay for that liquidity? And that greatly affects your choices moving forward, what you're able to do, things like that. And so it's no different for banks. It's going to change their ability to access capital, what price they pay capital for, et cetera. And it also just sort of makes them look bad. So if I have my money in a bank that I think is going to go out of business, I'm probably going to want to pull my money out of that bank and move it somewhere else, which is actually what caused those collapses that we saw in Silicon Valley and First Republic, and et cetera. It also would expect the banks to hold more capital on their balance sheets, which means they have to hold more money not really doing much as opposed to putting it out there, putting it to work, which is going to affect them. Per Moody's, they said, quote, that this comes as a mild U.S. recession is on the horizon for early 2024. So I'll just say that experts, through expert polls, Bank of America polls, et cetera, have dropped the percentage of expectation of recession from about 68 to 63 to now I think it's at 58%. We'll see where it comes out next month. Probably my guess is closer to 50-50. But Moody's is saying here part of why they're doing this downgrade is because of this potentially expected U.S. recession on the horizon. It says, quote, with particular risks in some banks' commercial real estate portfolios. So I've covered this on my main YouTube channel, Mark Moss. If you're not following me there, you should, because I do videos where I put the charts on the screen, the graphs, and if you want to see the visuals, it's very helpful to see that. But I talked about this before where the commercial real estate portfolio is really, really bad. And of course, it makes sense. Commercial real estate, namely office buildings, things like that, they're losing tenants. As a matter of fact, I believe at the time when I did the last report, it was 1 out of 5 office buildings aren't paying their rent. And so if you're not paying your rent, how do you cover your debt? And that's a big deal. And so that's what Moody's is saying here, risks in some banks' commercial real estate portfolios. Now, I'll just say that I think that just like when these other banks collapsed, I mean, the Fed basically set up, some backdoor deals, the BTFP programs, and gave the banks the money they needed. So the banks, while the banks went out of business, the depositors didn't really lose any money. Now, they also set up these backdoor funding channels to hopefully keep other banks from collapsing as well. But even though, like I said, these other banks they collapsed, so if you owned the bank or you worked at the bank or you had equity in the bank, that was a problem for you. But as a depositor in the bank, it didn't really matter. I didn't lose money in that transaction. And in my guess, I don't have a crystal ball, so take this for what it's worth, but based off of what I've seen historically and where the bank, where the government and the Federal Reserve is today, I think that this commercial real estate mortgage-backed security market, that's this big bomb that's about to go off in the economy, I think it's probably sort of like a nothing burger in a sense, where the Fed will probably just take those assets and put them on their books, and you don't have this massive collapse in the market. Now, that is a bad thing. It's not a good thing. It just prevents it from being this cataclysmic event that it all happens at once. But what it does do is it starts to consolidate the banks. So we're starting to see these smaller banks getting consolidated into bigger banks, which is exactly what happened with Silicon Valley and First Republic, where people pulled their money out and they sent it to the big banks like JP Morgan, et cetera. And the problem with this consolidation of banks is that it's the banks that actually create the money through loans. And what we do is instead of having these decentralized banks that are broken down with like local banks, regional banks, credit union banks, et cetera, that know me, know my business, know my local area, that can make a decision for me here, now all those decisions get pushed back to like a big bank like JP Morgan, and they make decisions from New York, and they don't know me, and they don't know my area or my business. And the problem is it's going to start to favor more and more liquidity for big businesses and much less for small business. So while it's not an imminent impact, I want you to understand, I'm saying I don't think it's going to be a big imminent impact. I think the Fed will kind of save the day there, but it is going to be a big long-term impact that's going to have massive downward pressure. Of course, if the liquidity dries up, then businesses don't get the funding they need. We don't have as many businesses, and the whole economy really suffers from that. Another thing that I saw was very interesting. So this is all pushing the Bitcoin narrative, of course. If your money's in the bank and the banks don't have your money and that you could lose it, then it sort of makes you not want to keep your money in the bank. And that's the whole point of Bitcoin. I can take custody of my Bitcoin. Nobody else needs to hold it. So I don't have to worry about it being there when I want it because I have it. But if you need even more bad information about the banks, we saw that banks were hit with $549 million in fines. Now, the banks get fined all the time because they're always doing bad things. All the bad things that they accuse Bitcoin and crypto of, it's the banks that do it. The banks got fined with $449 million in fines for the use of Signal and WhatsApp because they weren't keeping proper records. U.S. regulators on Tuesday announced a combined $549 million in penalties against Wall Street firms that failed to maintain electronic records of employee communications. So, the SEC, Securities Exchange Commission, announced charges against 11 firms for, quote, widespread and longstanding failures. Failures to do what? Failures to maintain records, including by allowing employees to use unsupervised side channels such as messaging apps, WhatsApp, and Signal. Now, the SEC disclosed charges of $289 million in fines against 11 firms for this. For the record keeping, and the CFTC, Commodities Futures Trading Commission, also fined 4 banks a total of $260 million for failing to maintain records. Now, out of this, any guess on maybe which bank got the biggest fines? Well, I can't hear you. So leave me in the comments. Let me know what you think. Which bank got the biggest amount of fines on this? While you're at it, if you could just like this podcast, just go to your favorite podcast player, like it, review it, mean the world to me. But the bank that got the largest fines is Wells Fargo. And that should have been an easy guess because Wells Fargo has already paid the largest bank fines in history. Seems like Wells Fargo is always paying bank fines. They paid the largest bank fine in history by putting accounts on adding accounts to other people's accounts without their knowledge, signing them up for new checking accounts, savings accounts, credit card account, whatever it may be, because they were trying to get their numbers up, and they got busted for that. CEO had to step down. They paid massive fines, largest fine in history, and here they are again, paying the Wells Fargo being the 4th biggest U.S. bank by assets, racked up the most fines on Tuesday with $200 million in penalties. Almost 50% of the penalties that were levied went against Wells Fargo. To name out of 11 banks, they whacked up about 50% of it. Pretty big deal. We saw French bank BNP Paribas fined $110 million. Bank of Montreal fined $60 million, and on and on and on. So if you needed any more reason why you don't want to keep your money in the banks, I've just given you several. Moody's has downgraded the credit. We're going to continue to see consolidation of it, and they're continuing to get fined for wrongdoing that they have. You know, it's funny because they want to put these new regulations on cryptocurrencies like Bitcoin to have what they call like a travel rule, so they know where the flow of money is coming from. They want to know the KYC, know your customer there, but yet they can't even get the banks to collect the data. The banks that are so heavily regulated, they've been around forever, that have that data, they can't even keep it, but yet they want to enforce it on crypto. It's funny.